Most of us walk around with a very specific idea of how investing works. You hit buy on a share of Apple, your $200 goes straight to Apple, and they use it to build the next iPhone. It feels like a corporate donation box. That transaction is entirely in your head. When you bought that share today, Apple didn't get a single cent. They don't even know you exist. You didn't pay the company. You paid a complete stranger, someone you will never meet, who just happened to decide that today was a good day to sell their slice of the pie. This exact exchange repeats at a staggering scale. Hundreds of billions of dollars change hands on American markets every single trading day, shifting the retirement savings of millions of people in a fraction of a second, all without the underlying companies participating at all. The fluctuating numbers on our screen track a secondary ecosystem, one that functions independently of a company's actual bank account. To understand what you're actually buying, we have to look back to Amsterdam in the early 1600s. But outfitting a ship, a crew, and surviving months at sea with pirates and storms was enormously expensive and incredibly risky. If a ship sank, a merchant lost everything. The solution to that immense danger was straightforward: split the risk. Instead of one person funding the entire voyage, dozens of everyday people could chip in a smaller amount. If the ship returned, everyone shared the profits. If it sank, no single person was ruined. This is exactly what the Dutch East India Company did in 1602. They issued the very first public shares, dividing the physical ownership of their massive, risky venture into thousands of affordable pieces. But owning one of those shares didn't mean you owned a specific cannon or a wooden plank on the whole. You owned an abstract claim on the future value of the entire business. It is a shared stake in the upside and a shared stake in the danger. Buying a stock today works the exact same way. You don't own a desk at headquarters. You own a slice of a pizza that hasn't been baked yet. You don't know how big it will get, but if the company expands, your slice grows with it. If companies don't make money from us trading their shares daily, why do they bother carving themselves up and giving away ownership at all? Because eventually, a growing business needs cash. If a small coffee chain wants to build 50 new locations, they could take out a massive bank loan, but that means heavy monthly interest payments whether the new stores succeed or fail. The alternative is an initial public offering, or IPO. This is the specific, isolated event where a company sells newly minted shares to the public. Here, investor cash flows directly into the company's treasury, and they use it to build those new stores. We call this specific capital-raising event the primary market. It is the solitary window where your investment actually funds the business. That window closes quickly. The moment the IPO ends, the company steps completely aside. From that point forward, they do not see another dime from the sale of those specific shares. Everything that happens after the IPO is the secondary market. This is the vast ecosystem where millions of previously issued shares live out the rest of their existence, being traded back and forth between strangers. To make this massive swapping operation work, buyers and sellers need to find each other. Originally, this meant chaotic physical shouting matches on a trading floor, manually pairing a human buyer with a human seller. Today, that physical chaos has been replaced by highly regulated algorithms. When you hit buy on an app, a network like the New York Stock Exchange or NASDAQ scans the market and mathematically matches your order in milliseconds. And the people passing those shares around have completely different goals. You have retail investors holding for a decade, day traders trying to scalp a quick profit in a few minutes, and massive institutional hedge funds moving billions of dollars at once. All of them are locked in a closed loop. They are continuously trading historical claims of ownership with each other, completely detached from the daily operations of the company itself. If the company isn't setting the retail value of its stock, how do we arrive at a single official price on our screens? This chart shows the core mechanics of a trade. Every stock has a bid, which is the highest price a buyer is willing to pay, and an ask, the lowest price a seller is willing to accept. When those two numbers meet perfectly in the middle, a trade executes, and that exact number becomes the new official price. If there is heavy demand, desperate buyers start to outnumber the available sellers. To convince someone to hand over their shares, those buyers have to continuously raise their bids, driving the equilibrium price higher and higher. Conversely, if there's panic, sellers outnumber buyers. They have to continually undercut each other, lowering their asking price to attract any available cash, pulling the stock price down with them. The official price of a stock is simply the point where immediate supply and demand find an equilibrium. Stock prices track the shifting consensus of what might happen tomorrow, largely ignoring the reality of today. This is why a tech startup with absolutely zero current revenue can be valued at $1 billion. Investors are buying the collective belief in its future dominance. In this chart, we see how a company's actual reported earnings compare to the expectations investors held before the announcement. The math is unforgiving. If the reported reality is fantastic, but it still falls short of the massive expectation built up by investors, the market corrects downward immediately. Every movement on a stock ticker provides a real-time, quantifiable readout of collective human expectation. If the company isn't setting the retail value of its stock, how do we arrive at a single official price on our screens? A stock has a bid, the highest a buyer pays, and an ask, the lowest a seller accepts. When they meet, a trade executes at the official price. Rising demand makes buyers raise bids, pushing prices up. Panicking sellers undercut, pulling prices down. The official price of a stock is simply the point where immediate supply and demand find an equilibrium. Stock prices track the shifting consensus of what might happen tomorrow, largely ignoring the reality of today. This is why a tech startup with absolutely zero current revenue can be valued at $1 billion. Investors are buying the collective belief in its future dominance. Here, we see how a company's actual reported earnings compared to the expectations investors held before the announcement. If the reported reality is fantastic, but still falls short of the massive expectation, the stock price corrects downward immediately. Every movement on a stock ticker provides a real-time, quantifiable readout of collective human expectation.